Hi, I'm David Armstrong. I'm the managing editor of Registered Rep Magazine and wealthmanagement.com. We're here at the Tiburon CEO Summit in San Francisco. I'm here with Matt Lynch, principal of Tiburon Strategic Advisors. Matt, thanks for taking the time.
Sure. Good morning.
Great conference so far.
Thank you.
What are you hearing from some of the participants here? What are some of the themes that seem to be coming from the folks up here who are talking?
You know, it's David. It's very much a continuation of the themes that we saw, at our summit earlier this year in New York. Concerns around the broader economic environment. Added to that, the uncertainty around the election,
Sure.
tax policy, the regulatory environment. But that said, I believe there is a cautious optimism among the attendees here, the CEOs of a lot of these organizations that are represented here at the Tiburon Summit, that you need to continue to innovate. You need to be prepared to invest in new products, innovations in terms of distribution strategies, new types of pricing, and just ideas that can be launched to complement existing businesses to respond to changing consumer expectations. There's that pent up demand, I think, is turned into firms moving forward with some pretty creative ideas and a high energy level to try to solve some of the challenges that consumers have meeting their own financial goals.
Can you give me one example of a firm with a creative idea and a new innovative strategy?
Sure. Well, there's certainly a number of them. One of the things that we heard about at the conference is the continued focus that firms have on meeting consumer expectations, right? So whether it's Schwab lowering ETF fees, which we saw were recently announced, whether it's the innovative firms that are supporting the new do-it-yourself and aided do-it-yourself platforms. We've seen what's happening at Personal Capital and Betterment and other firms out there, and the coupling of technology with the investment management process that even some of the traditional bricks and mortar companies are doing, right?
Mm-hmm.
And trying to get out to maybe the masses, more of the middle market consumer with advice and products and services, so that they can be better informed and be comfortable in their investment decisions. I mean, those are examples of some of the things that I think are in motion.
That combination of technology and the face-to-face personal financial advisor, it's not the sort of thing where the financial advisor needs to fear companies like Personal Capital that robo advisors that are going to be doing it for them.
Yeah, no, I don't think it's a fear of from on the part of the traditional advisor that the technology is going to marginalize their role, right? But ultimately, it's all about what the consumer wants, right? So I think that what we're seeing with Personal Capital and other firms is a creative response to a changing consumer expectation. I mean, we used to have the discount brokerage models, the online brokerage, very much transaction focused, and now we're seeing turnkey asset management programs. You can custom design your own portfolio of 30 or 40 stocks and trade those in a bundled way, and have whatever degree of help you desire as a consumer is available through these providers, whether it's banks or investment management firms or others. And I think the key is that the consumer wants advice, but on their terms,
mm-hmm.
right? They want it on the iPad. They want it to be an app. Some of them want to make their own investment decisions. And I think that the advisor of the future needs to recognize that and position their services in a way that the consumer is going to believe there's value. Mm-hmm. Sometimes that's the face-to-face conversation. Sometimes that's providing planning and advice. Other times it's communicating through tools and a dashboard and through social media,
mm-hmm.
right? And things as basic as email. But I think that the advisor of the future needs to adapt to that, and it certainly depends on the market segment that they're serving, right? In the high net worth, different types of issues than perhaps the mass affluent, and there's also the issue of the economic model, right? I mean, can you afford with margin compression and low cost investment vehicles? As an industry, we need to figure out how to serve the masses in a profitable way. right? And so I think that's part of the innovation economy. That's part of what the folks at this conference are talking about in terms of how do they get to those consumers that really need advice, right? And we learned in this meeting that that there's a high percentage of Americans with less than $8,000 in savings that are within 15 years of retirement. There's work to be done, right? They need the services that financial services firms like the ones represented here can provide.
Speaking of the future a little bit and the changes, technology, why doesn't the industry do a better job of quote unquote onboarding younger financial advisors, training programs, bringing the younger generation into the industry? We know the wirehouse world, those training programs are a disaster. Very few make it out. A waste of money. With the industry overall, what's going on? How come it's difficult to?
It's a great question. I'm not sure that there's an easy solution. 25, 30 years ago when I came into the business, there were dozens of options as far as how you could get really good training and support and be compensated while you were learning, right? From the wirehouses that were doing a better job of it at that time. There were multiple insurance companies that would provide great training grounds, and all but a few, quit doing that and quit developing new agents or reps or advisors. A lot of it was the cost structure, right? It's just incredibly expensive. If you look at some of the industry data over the years, if you look at LIMRA data as an example, it's really focused on the insurance segment, but it's instructive. The 4-year retention rate for new agents coming into the business was somewhere around 11%, right? So it's really hard to justify that, as far as a way to build distribution. And then also there's the folks that are coming into the industry that are graduating from great programs like the Personal Financial Planning program at Texas Tech and other schools, where they really, they're coming in with a desire to join a firm and use their skills, whether it's financial planning skills or portfolio management skills, and really be more in a support role and not necessarily start their career by cold calling or trying to find their friends and family and convince them to do business. I think that model is much less relevant today and not attractive to the next generation. So the industry has some catching up to do. For a while it's just been moving the same number of advisors between the wirehouses or between the firms, and what we've seen is this movement to the independent model. And now the independent model is maturing, and they're starting to add new associates into the larger super RIAs or in the broker-dealer world, the super OSJs, where they're building out teams and providing support. I think that's probably where the next generation of advisors comes from. I don't think that we're going to continue to see the wirehouses or the insurance companies be the training ground and the farm team. I think it's the graduates of these programs are going to come right into the industry, more likely into the RIA space, than to go through the various steps that we have seen in the last few decades.
It also doesn't help, I think, that the financial services firms overall, the financial services market has been kind of tarnished with a bad reputation in recent years. How do we overcome that trust gap in terms of clients and even people who want to go into the industry maybe think, well, that's not the industry for me because it's
right. Well, that's the thing. I mean, there's a lot of self-inflicted wounds, right, that the industry continues to be guilty of, and the various scandals and the regulatory issues, and there's a huge trust gap between Main Street and Wall Street, right? And that's part of why I think we see the movement toward the do-it-yourselfer approach, where advisors don't see these big companies as necessarily being on their side. The whole debate over the fiduciary standard and the regulatory change, the implications of Dodd-Frank, even though it's only 1/3 implemented at this point, greater transparency. I mean, we're going through a change as an industry, but we've got to go back and earn the trust of the investing public. I don't think we've lost it, but there is a gap there, right? Where we have to provide greater transparency, clarity in terms of the value proposition that investment advisors bring, and they provide a very important role and they add value. But it's just getting that story out and recovering some of that lost credibility that I think represents a challenge for the industry.
Well, it's an opportunity as well, right? Because people like their financial advisor, they don't like the firm that works for them,
That,
but they like the financial advisor.
that's
themselves.
exactly
So-
right. It's kind of like Congress, right?
Yeah.
Congress has a 15% approval rating,
Yeah.
but everybody reelects their
Yeah,
congressman,
their own
same
congressman.
type of thing, right?
Well, this has been great. Matt, thanks very
Great.
much. Appreciate it.
Thank you.
Thanks for taking the time. Thank you.